Something is happening right now, and almost no one is talking about it. Not on the news, not on social media, not even the so-called experts. But the signs? They're everywhere. In your grocery bill, in your bank account, in the way people are quietly changing how they spend, save, and survive. And here's the dangerous part. By the time most people realize what's going on, it's already too late. This channel exists for one reason: to show you what others miss before it impacts your life. So if you've ever felt like something doesn't add up, like the story you're being told isn't the full truth, you're in the right place. Let's break it down. If you've made it this far, this channel is for you. Not for everyone, just for the people who want to understand what's really happening beneath the surface before everyone else catches on. I don't post noise. I don't chase headlines. I break down the signals that actually matter. The ones that affect your money, your future, and your decisions. And over the next videos, I'm going even deeper into topics like where the next financial pressure will hit, first how smart people are quietly preparing right now, the hidden risks most people are completely ignoring, and the opportunities that only show up in uncertain times. So if you want clarity instead of confusion, if you want to stay ahead instead of reacting late, then subscribe now. Because the next video might be the one that changes how you see everything. Something is quietly breaking beneath the surface of the American economy, and most people won't notice until it's too late. Not because the signs aren't there. They are. They've been building for months, flashing in data reports, in grocery store receipts, in the faces of people who used to feel financially secure and now find themselves quietly anxious, quietly stretching every dollar further than it was ever designed to go. We're not talking about a distant recession warning from some economist in a glass tower. We're talking about signals coming from the ground up, from real spending habits, real job markets, real households. And when you line them all up together, the picture they paint is one that demands your full attention right now. So let's talk about what's actually happening. Not the sanitized version. The real one. For the last couple of years, there's been a comforting narrative playing on repeat. Inflation is coming down. The job market is strong. The economy is resilient. Soft landing achieved. Move along. And on the surface, some of that is technically true. Inflation has cooled from its brutal peak. Unemployment remains historically low. The stock market, at various points, has looked downright cheerful. But here's where things get interesting. Because beneath those headline numbers, the ones that make it onto the evening news, there's a completely different story being told. And it's a story about stress, about cracks, about a system that has been held together with extraordinary pressure for an extraordinary amount of time, and is now beginning to show what that pressure has done to it. Think about that for a moment. What happens to anything, a bridge, a pipe, a human body, when it's under sustained stress for too long? It doesn't always collapse dramatically. Sometimes it just quietly weakens. Until one day, the weight becomes too much. That's where we are right now. Let's start with something that touches everyone directly. Consumer spending. America's economy runs on consumption. About 70 cents of every dollar of economic activity in this country comes from people buying things. Groceries, cars, vacations, electronics, healthcare, housing. When Americans spend, the economy grows. When they stop, or can't, everything downstream feels it. For a while after the pandemic, Americans kept spending even as prices soared. Part of that was the stimulus money still working its way through households. Part of it was credit cards. Part of it was a genuine psychological desire to live, to travel, to enjoy life after years of lockdowns and fear. But that fuel is running out. The personal savings rate in America, meaning the percentage of income that households are actually saving, has dropped to dangerously low levels. At its peak during the pandemic, Americans were saving nearly 30% of their income. Today, that number has collapsed to somewhere around 3 to 4%. And for tens of millions of lower and middle income households, it's effectively zero or negative. That means people aren't just spending their income anymore. They're spending their savings. They're borrowing. They're using credit cards as a lifeline, not a convenience. And here's the surprising part. Total credit card debt in the United States has crossed $1 trillion for the first time in history. Not as a passing moment, as a sustained reality. Americans owe more on their credit cards than ever before in the country's existence. And the average interest rate on those balances? Over 20%. Let that sink in. People are borrowing money at 20% interest just to cover everyday expenses. That's not a sign of consumer confidence. That's a sign of desperation wearing the mask of normalcy. Now you might be thinking, okay, but people are still spending. Doesn't that mean things are fine? That's exactly the trap. Because when you look at what people are spending money on, the picture shifts dramatically. Spending on essentials, food, rent, utilities, insurance, healthcare, has surged. But spending on discretionary items, the things people buy when they feel good about their financial future, restaurants, travel, home renovations, electronics, clothing, that has been softening in ways that are hard to ignore. Major retailers have been sounding quiet alarms for months. Dollar stores, historically a place people shop when times are tight, have seen unusual softness in their own customer base, meaning even the value-seeking shopper is pulling back. Companies like Target, Walmart, and dozens of others have talked openly in their earnings calls about a consumer who is tired, stretched, and increasingly selective. When the budget shopper starts cutting back, that tells you something important about where the financial pressure is reached. And then there's food. The one thing people cannot cut out entirely. The average American family is spending several $100s more per year on groceries than they were 3 years ago. The price of eggs, coffee, orange juice, bread, the most basic staples, all dramatically higher. And wages, while they have grown, have in many cases not kept pace with the cumulative price increases that have compounded year after year. Here's the brutal math that doesn't get discussed enough. Even if inflation slows to 2%, that doesn't mean prices go back down. It just means they stop rising as fast. Everything that became more expensive over the last 3 years, it stays at those higher levels. The grocery bill that jumped 30 or 40% doesn't reset. It just grows more slowly from an already elevated base. That's the cost of living cliff that millions of households are living on the edge of right now. But that's not all. Let's talk about the housing market, because it may be the single most important economic pressure point in the country right now. The American dream was always tied to homeownership. The idea that if you worked hard and saved up, you could buy a place, build equity, create stability, and pass something down to your children. That idea is, for a significant portion of the population, no longer within reach. Mortgage rates climbed dramatically from their pandemic lows of around 3% to 7, 8, and even above 8% at various points. The result is staggering when you do the actual math. A home that would have cost you roughly $1,500 a month to finance in 2021 now costs you closer to $2,500 or $3,000 for the same property. That's not a marginal difference. That's the difference between affording a home and not. And because existing homeowners with low locked-in rates have little incentive to sell and give up their 3% mortgage for a 7% one on a new purchase, the supply of homes for sale has remained severely limited, which means prices haven't crashed the way many people expected them to. Instead, the market has frozen. Low supply, low demand, high prices, High rates. First-time buyers, younger Americans trying to build their version of the dream, are essentially locked out. They're renting instead, which means the rental market has stayed elevated. And if you're renting and spending 40, 50, sometimes 60% of your income on housing, there's very little left over to save, to invest, or to absorb any financial shock. The ripple effects of this housing gridlock are enormous. When people can't buy homes, they don't buy furniture, appliances, or hire contractors. The construction industry slows. Local tax bases shift. Communities age in place while younger generations cluster in apartments far from where they grew up. And that's before we even get to the commercial real estate story, which is a slow-motion crisis unfolding in plain sight. Office buildings in major American cities are sitting significantly empty. Remote work hasn't reversed the way landlords and city planners hoped. Loan maturities are coming due on properties whose values have declined sharply. Regional banks, which are heavily exposed to commercial real estate, are sitting on losses they haven't fully acknowledged. This isn't theoretical risk. It's a documented reality that regulators are quietly watching with significant concern. Now wait a second, what about jobs? Isn't the labor market still strong? This is the part of the story that requires the most careful reading, because the headline unemployment rate has been used as a kind of trump card to dismiss concerns about the broader economy. And yes, officially, unemployment remains low. But look closer, and you see a more complicated picture. Job growth has been slowing. Revisions to employment data, meaning the government going back and adjusting previously reported numbers, have in recent cycles consistently revised job gains downward. In other words, the original report suggested more hiring than actually took place. That matters. Full-time employment has been weakening relative to part-time employment. More people are working multiple jobs just to meet their monthly obligations. The number of Americans working 2 or more jobs is near multi-decade highs. And that's not a sign of ambition, it's a sign of necessity. Layoffs in technology, finance, media, and professional services have been significant. The names of major companies announcing workforce reductions, sometimes 10, 15, 20% of their headcount, have become almost too frequent to track. These aren't small businesses making quiet cuts. These are some of the most prominent employers in the country, reshaping their workforces in response to economic uncertainty and the rising cost of capital. And then, there's something that doesn't get nearly enough attention: the quality and wage trajectory of the jobs being created versus the jobs being lost. When a company cuts a $120,000 software engineer position and replaces it with a $45,000 customer service role somewhere else in the economy, the headline unemployment number might stay the same. But the economic impact is dramatically different. For the individual, for their family, for the community they spend money in, everything changes. Honestly, most people don't realize this when they hear the unemployment rate cited as evidence of economic health. The rate tells you how many people have jobs. It doesn't tell you what those jobs pay, how stable they are, or whether they're enough to live on. Here's where things get truly unsettling, because we haven't even talked about debt yet. Not consumer debt, we covered that. Government debt. The United States is currently carrying a national debt that has crossed $36 trillion. The annual interest payment on that debt has now surpassed $1 trillion per year. Not the debt itself, just the interest. To put that in context, the United States is now spending more money on interest payments than it spends on national defense, more than it spends on Medicaid, more than almost any other single-line item in the federal budget. And interest rates, while they've moved somewhat from their peak, remain elevated by the standards of the last 15 years. Every percentage point of interest rate matters enormously, when you're paying interest on $36 trillion. This creates a fiscal pressure that operates in the background but shapes everything. Because when the government needs to spend money on disaster relief, on recession stimulus, on wars, on healthcare, it has to borrow. And borrowing at these rates is far more expensive than it used to be. The financial flexibility the U.S. government once had to respond to economic downturns has quietly eroded. And then something unexpected happened that made this even more complicated. The relationship between the United States and its major trading partners began shifting in ways that were hard to predict. Tariffs, trade barriers, supply chain restructuring, the push to bring manufacturing back to American shores. A goal that sounds appealing but carries real economic costs during the transition period. When you suddenly put significant tariffs on goods from major trading partners, the costs don't disappear. They get passed through to businesses and ultimately to consumers. The global trading system that kept prices low on electronics, clothing, appliances, and thousands of other goods for decades is being restructured in real time. That restructuring may have long-term strategic benefits, but in the short term, it adds inflationary pressure at exactly the moment when inflation was just beginning to recede. That's the bind. The pressure from all directions at once. Let's talk about what all of this means for ordinary people. Not for hedge funds or investment banks. For real households trying to figure out how to navigate what's coming. The signals that are worth paying attention to are the ones that show up in behavior. Not in what people say, but in what they do. People are not refinancing their homes at the rates you'd expect if they felt financially secure. They're not making major purchases. They're not switching jobs as freely as they were 2 years ago, when the labor market was so hot that workers held enormous leverage. That leverage has diminished. People are staying put, not because they love their jobs, but because they're uncertain about what's on the other side. Delinquency rates, the percentage of borrowers falling behind on car loans, credit cards, and other debt, have been rising. Not to crisis levels. Not yet. But trending in a direction that credit analysts are watching carefully. When a growing number of households can't keep up with their existing debt obligations, it's a leading indicator, a warning sign that shows up before the bigger problems become impossible to ignore. And there's something happening in the small business world that deserves more attention than it gets. Small businesses, the restaurants, the retail shops, the local service providers, are facing a brutal combination of higher operating costs, higher borrowing costs, and consumers who are increasingly price sensitive. Business formation data shows strain. Business closure rates in some sectors have been elevated. These aren't just statistics. Each one of those closures is someone's dream, someone's livelihood, someone's attempt to build something. And when small businesses close, the communities around them feel it. In lost jobs, in empty storefronts, in the slow hollowing out of local economic life. So where does this all lead? What happens next? Here's where honesty matters more than comfort. No one, not the Federal Reserve, not the Treasury, not any economist, can tell you with certainty when, or whether, the warning signals we've been discussing will escalate into a full recession. Economic systems are complex. They can absorb more stress than you'd expect, and then break suddenly, and seemingly without warning. Or they can stabilize, adjust, and avoid the worst outcomes. What we can say with confidence is this: the margin for error is thin. The buffers that existed 5 or 10 years ago, low interest rates that could be cut aggressively, government balance sheets with room to borrow and spend, consumers with savings, those buffers are diminished. The tools available to respond to a downturn are fewer and more costly to use. That's what makes this moment different from other periods of economic uncertainty. It's not that disaster is guaranteed. It's that the safety nets are smaller, and the tightrope is longer. For individual households, this is actually the most actionable part of the conversation. Because while you cannot control trade policy or Federal Reserve decisions or the commercial real estate market, you can control your own financial position. Think about what reducing your monthly debt obligation by even $100 or $200 would mean for your breathing room. Think about what a genuine emergency fund, not a theoretical one, but an actual one with 3 to 6 months of expenses in a liquid account, would change about how you sleep at night. Think about the job skills you have and whether they're durable in a market that is changing quickly. Think about whether the major financial commitments you're considering, a new car, a move, a renovation, are things you can genuinely absorb if income gets disrupted. None of this is panic. This is preparation. And there's a meaningful difference. Here's something that history teaches us, though, and this is important. Economic downturns are awful when you're unprepared for them. They are survivable, even navigable, when you're not. The people who look back on difficult economic periods and say they came through okay are almost never the ones who predicted every twist and turn. They're the ones who were holding less debt, more savings, and more flexibility when the turn came. And the people who come out ahead during periods of economic dislocation, who find opportunity in disruption, are almost always the ones who understood what was happening around them, who stayed calm, and who made decisions from a place of clarity rather than fear. That's what this moment calls for. Not fear. Not denial. Clarity. The signals are real. The pressures are real. The uncertainty is real. And pretending otherwise because the headline unemployment rate is still low, or because the stock market had a good quarter, or because someone on television assured you everything is fine. That would be the most expensive mistake you could make right now. There's a deeper truth underneath all of this, and it's one that doesn't get discussed nearly enough. Economic warning signals are not just about numbers. They're about trust. They're about whether people trust that tomorrow will be reasonably similar to today, whether they trust that their money will hold its value, whether they trust that the institutions designed to protect economic stability are capable of doing so. And right now, that trust is under significant strain. Not broken, but tested in ways it hasn't been tested in a long time. The gap between official narratives about the economy and what people are actually experiencing in their daily lives has become a kind of wound in public confidence. When someone is told the economy is strong while they're choosing between groceries and medication, the disconnect doesn't build trust. It erodes it. Rebuilding that trust through policies that actually address affordability, through honest communication about trade-offs, through a genuine focus on what economic health means for regular people rather than just for asset prices. That is the real work ahead. So here's where we land. America's economy is not in freefall, but it is sending warning signals that deserve serious attention. Consumer stress is real and rising. Housing affordability has reached a crisis point for millions of households. The labor market is softening beneath its strong headline. Debt, consumer and government, is at historic levels. And the global economic environment is more uncertain and more volatile than it has been in decades. The question isn't whether to be worried. The question is what to do with that awareness. Use it. Get your own financial house as strong as you can make it right now, while you have time and agency. Understand what's happening around you so that decisions about jobs, about spending, about investing, come from a place of clarity. Don't wait for someone on television to give you permission to take your financial future seriously, because the people who brace for impact aren't the pessimists. They're the ones who show up on the other side of the storm still standing. And that, more than any market prediction, more than any economic forecast, is what you actually have control over. The signals are there. You've heard them. What you do next is up to you.